Hello there, I'm Alex, your host again. Welcome back to the Stock and Tech Academy channel. Last time, our friend Sam learned the hard way that blindly copying other investors isn't a winning strategy. Now he's done a bit more research and has picked some stocks he thinks he understands based on his own initial analysis. But investing is rarely a straight lineup. There will be bumps along the way. Mistake number 2. Selling in fear. Suddenly, the market takes a steep dive. Alarming headlines flash across the news. Social media is buzzing with negativity, and everyone seems to be predicting doom and gloom. It feels chaotic, overwhelming, like the financial world is crumbling. Sam's gut instinct, fueled by pure fear, is screaming, "Get out now!" Overwhelmed by the noise and his own rising panic, Sam throws his strategy out the window. He hits the sell button, liquidating his investments at significantly lower prices than he bought them for. He locks in those losses, telling himself he just wants the anxiety and stress to stop. He feels a moment of relief, but at what cost? But here's the thing about markets. They fluctuate. Historically, downturns are followed by recoveries. Sure enough, not long after Sam sold everything in a panic, prices began to stabilize and then climb back up. He sold low, right near the bottom, and completely missed the eventual rebound because his decisions were driven purely by fear, not by a rational assessment of the situation or his investments. This painful experience highlights the importance of understanding the fundamentals. What does that mean? It means looking beyond the daily noise and the fluctuating stock price to understand the actual health, quality, and long-term prospects of the companies or assets you've invested in. Are they still solid businesses? Think of it using Benjamin Graham's famous Mr. Market parable. Imagine the market is a moody business partner. Some days, Mr. Market is euphoric and offers to buy your shares at a ridiculously high price. Other days, he's deeply depressed and wants to sell you his shares for pennies on the dollar. Graham's point? You don't have to transact with Mr. Market based on his wild mood swings. You can ignore him unless his price offers a real opportunity. Warren Buffett, who learned from Graham, built on this idea. He famously advised investors to be fearful when others are greedy and greedy when others are fearful. Panic selling during a downturn is the exact opposite. It's being fearful when everyone else is fearful, which is often the absolute worst time to sell good investments. Don't let fear hijack your investment strategy. Focus on the long term and understand the fundamentals of what you own. Emotional reactions rarely lead to good financial outcomes. Next time, we'll tackle a different kind of fear, the fear of missing out, and why it leads to buying stocks at the wrong time. I really hope this helped clear things up about getting started with investing. If it did, hitting that like button really helps others find this video too. Share it if you know someone asking these same questions, and subscribe so you don't miss our next video breaking down more investing basics. See you next time.